classes, appraisals and title. We have Shaun Moamem, and Shaun is one of the owners principal of Empire Title Agency. And I've been doing work with Shaun for years. He's been in the business for a long time. And it happens to be, everyone throws around title this, title that. Yeah, it is about relationships, but at the same token, it's really also about what it's really about is getting the help that you need when you need it, and somebody that you could really count on, and being your partner, throughout, whether it's, a new development that you're working on, or you're on the buy side or the sell side. Shaun's just been great for so long. And, I'm proud and happy to send to my business. So anyway, with
Thank
that,
you.
Shaun, it's so great to see you.
Nice to see you as well, and I appreciate that. Yes, we've been working together a long time, and I think for all people in sales, the most important thing for us is service. So people talk about title, and they don't think about how important it is to have a great team. Like having a great attorney, right? Just like a real estate agent themselves, right? They need to be providing the best service. We have a lot of times the same access to data, right? But being able to work efficiently, and provide the best value and service to our clients is what matters most.
Right. Now, Shaun, so I'll give an example. Let's just say a broker has a listing, and they don't know if it's possible to really list yet, because maybe the seller of the property is already in debt, and they're concerned that maybe there's just too much debt on the property that they may not even be able to sell it. So I know we've had these situations. So just tell us, like, what it is that you can do in those circumstances to help the brokers out, because that's really what it's about. Look, Shaun's helping me, he's helping the attorneys, he's helping the back end office of the underwriters, and he's really there to help you guys as brokers. So
Yeah, I'll give it a great example, or I'll give it a great reason in general why it's important to have a preferred title vendor, someone that you can lean on for these things. Because similarly to how you have a go-to mortgage banker, and us in New York State, we are on the buy side of things. The buyer side of the transaction pays for title insurance, just like the buyer's side is taking out a loan for a mortgage, right? But at the same time, you're working through issues that the seller may have to make sure the buyer doesn't inherit any of those issues. So one really important thing that I always say to agents that are representing the sellers, you should get out ahead of it, because the process for a normal transaction is a little backwards. Like a simple phrase that I always say is take out the word title for title insurance and title report and swap in due diligence, right? It's a due diligence report. So your thought process should be like, okay, we want to get out ahead of it so that when you are representing a seller, that you're listing a sellable asset. And it's not that necessarily title may, kill a deal or not make it not capable of you being able to sell it, but it may delay the sale of the deal. So a certain thing, like for example, you want to take a look at, let's say you have a townhouse or a combination unit. You want to make sure that there were probably open permits where they closed out properly, because now certain banks may not lend in that, if there are open permits in that property. And sometimes buyers may not want to buy it if there's, open permits. A lot of times title companies, we will still lend, we will still insure, I should say, on those types of assets. But these are some of the few things that come up in the title report that you guys don't find out about until contracts are signed. Right. The process is you'll represent a seller for 6 months before you accept an offer that your seller is happy with. You then engage attorneys, right? Represent you, like Jamie. The attorneys now negotiate contracts. Then once contracts are signed is when someone, or Jamie representing the buyer, would order a title report from me, right? So think about that. Think about how long you guys have been working on the transaction before the title report, which I said take out title report, due diligence report, was ordered. And in that report, we'll show you any of those issues that may delay the closing, whether there's open permits, violations, liens, any encumbrance of any kind that may hinder the buyer's ownership rights in the future. So these are important things to kind of get out ahead of when you're representing, your sellers. You even more so feel free to reach out to me when you're going into a pitch. You may want to be able to pull additional data that you can bring up to your potential seller and say, hey, look, by the way, I got out ahead of this and I did the due diligence. I pulled title and I, found that you had a sidewalk violation in front of your townhouse. We should get out ahead of this so that it doesn't delay closing once we're in contract, right? Things like that.
Now, what about, let's just say, I know with me, I have a lot of this in my office as well, where I might just have a deed transfer. I just may need to pull a deed. I can obviously do it. I can go on Acris, but things like that, a broker says, I just want to know who owns this property. Is that
Sure.
something that you can help them with?
Absolutely. So I think it's a another important part. A lot of times you'll go and you'll talk to a seller. How do you know if it's the rightful seller that allows you to sell the property, right? You want to make sure that you know the correct ownership. Sometimes you're just curious on who the owner is. If you can pull owner information on let's say a neighboring property on a floor that you just sold in the building of, right? So you want to maybe be able to access that info. You can reach out to me and I can pull the deed. We can see who the last owner of record is. A lot of times, with the property is owned in an LLC, it's a little bit more difficult to find out exactly who has ownership and management rights of the property because they'll have a partnership and operating agreement that we may not have access to, but we can still see who filed that agreement, right? Who filed for the LLC. So we may have a contact, whether it's an attorney or someone that could be able, good data or information for you.
Good stuff. Now, let me ask you, what is there any form of a program? Sometimes I know you could log in remotely, and if somebody just wants, let's say, a client says, what's it going to cost me on title? Is there somewhere that they can calculate this themselves without having to go through you?
Well, yes, we have a quotes at info where basically you just send a quotes at email, and you send in just the purchase price and the mortgage amount, and it basically calculates a closing cost estimate for you, which is almost exact to the dollar, right? Accurate. You just need to let us know what county it's in, right? If it's in Manhattan, whether it's in Brooklyn, whether it's in the Hamptons in Suffolk County, right? And within a few minutes, you will have a closing cost estimate. It's something I always say to agents to reach out to me for too, because you never know, right? You may be working with a buyer who's got a wide ranging budget. They might have a $2 million budget if it's something that needs work, all the way up to $2.5 million if it's turnkey and beautiful, right? So they're going around, they see two things in those two different price ranges, right? 2 million and 2.5. They want to make an offer for it. You can now say, okay, well, here what your closing costs are going to look like at $2 million with a traditional mortgage of 70-80%, and then it tells you everything, right? Whether what from the title insurance costs to the mortgage recording tax and et cetera. So now you have two different price points, 2.5 million and 2 million, and you can share that with your buyer, and so they understand, because most of your buyers aren't going to be savvy real estate investors. They're first time home buyers, maybe second time home buyers. They're lawyers, doctors, etc. So they think, oh, I just got to put my 20% down and that's about it. But there are other closing costs that you're going to make them aware of. But now you can do it with an even more detailed closing cost estimate. So you could just send it over to our quotes at email, and they'll automatically send you over a example of a quote. But to just give you a rough estimate, so you guys have for your own knowledge, title insurance premium is state regulated, which means that no matter what title company you use, it's the same price no matter what, and that regulated price is based off of the purchase price. And the great example I always give is $1 million condo, all cash. You're looking at about a third of a percent. So about 3,300 to 3,500 is your title insurance costs. $1 million condo with traditional financing, so 70-80% mortgage, you're looking at about 0.5%, so about $5,000 in title insurance costs. So you guys can gauge between that, but just so you know, it's about anywhere from a third to 0.5% based off the purchase price.
Can you do this in other states too? And do those numbers change?
Yes, they do. So this is a New York pricing that I gave you. We are currently expanding nationally. We are already in, Philadelphia, in Pennsylvania, New Jersey, and Florida. We are obviously here in New York. I'm in New York now, and we do a ton of business in all of those states. And each state varies. The premiums amount change based from state to state. They're not the same.
Is it the whole state the same, or are there changes in title from county to county here in New York as well?
No, so in New York there will be specific fees that make change, but no, the state isn't. The premiums are stay regulated and are the same no matter what. Whether you're in Suffolk County or Nassau County or Kings County, Manhattan deal is based off the same rates as a Hamptons deal. Whereas in Florida, things do change from county to county. Whereas in like New York, the buyers pay for title insurance no matter what part of New York it's in, and the pricing is exactly the same no matter what part it's in. Whereas in Florida, for example, Dade County, where Miami-Dade is, right? The buyers pay for title insurance, and the pricing can change. In Palm Beach County, the sellers pay for title insurance, and also the pricing on your title insurance premium can change. So it's different.
Do the
New York,
sellers pay for it or the sellers have to provide it?
they sell both. So the sellers provide it. They're doing their due diligence. It's funny, it's not an attorney state, right? So it's
Right.
different than how it is here in New York. The agents actually draft up the contracts themselves, and then they order it. The seller's side in Palm Beach will order it through the title company. Though they would reach out to me, and then we provide them with the report, with the bill, which the sellers will pay for at closing.
Now, just to clarify, because I don't want people to get confused, when you talk about it being the same throughout New York, we're only talking about title. That's not going to hold true as far as, let's say, out east you have the Peconic Bay,
Yeah,
just
Peconic.
right,
Yeah, that's an additional tax that you pay,
right,
similarly to how it differs in New York having to pay a mansion tax, right? You know,
right. And the other one was mortgage recording tax. Unlike title, mortgage recording tax does vary county to county.
Sure, it varies county to county, and of course, also based on the mortgage amount.
Yeah.
So those things, yes, but that's why this is, of course, you guys want to do your best to try to be as educated as you can. But one of the nice things of having someone like me or a title company who can provide these things for you is that we do this all day. So you just shoot us over the information. We pump out a estimated closing cost, which is almost accurate to the cent for whatever market you tell us it's in, and you don't have to navigate through those different fees and percentages for each county in New York.
Let's say you just want to know the judgments. Like, are there judgments? Are there liens? We're not looking for the closing costs. We just want to see what lies ahead. What would be the process of going about doing that?
So one of the things that I can maybe provide you, Jamie, to send out to the attendees today is our Empire National Title search sheet. And on our search sheet, it explains exactly what each of these searches that are all encompassing in a title report. But for example, you want to do, you're selling a co-op. You may just want to check for a lien search and judgment search to make sure the person that owns those shares of the corporation doesn't have any issues or liability attached to themselves or to the unit when selling it. So that's something separate than a full title report, which may incorporate municipality searches and et cetera. So one of the important things I always say for co-ops is make sure that if it's something there's been work that's been done, make sure to just check for a lien search, judgment, and any open permits. So those are separate searches, and each search, takes different time to put together and different turnaround time, like 1 to 2 days. But these are important things because these are things that all kind of come together to potentially delay a deal. So understanding that, hey, and a lien search for us can also include what the mortgage amount is. So it's important for you guys to be able to look into it and say, hey, what's the outstanding mortgage on this property? Because you want to be able to maybe understand the sensitivity of which your seller or the property that your buyer is interested in, and okay, well, they have no debt. There's no recorded mortgage on this. They have no debt. They have plenty of room, maybe potentially to work with here because they're going to walk away with a lot. Or as they have a super high mortgage and the market has taken a downturn, and they may not be a lot of room there to wiggle and negotiate with. So these are another thing, another search that we can do for you: open mortgage search, lien search, things along those lines.
I want to clarify just so everyone's aware. Shaun can do an open mortgage search. It will tell you whether or not a mortgage is still at the property, but he won't be able to tell you from the search publicly how much is remaining still on the mortgage. The only way we can get that done is we get an authorization from the borrower, and then we could contact the lender once we have, the loan number, and that's how we get the balance of it. Um,
Sure. Exactly. And the truth is also the at the same time, right? Every time that owner refinances the property, a new mortgage is recorded. So if a new mortgage is recorded, and let's say they recorded the mortgage in November of 2025 for 800,000 and we're in February 2026, you can imagine that the balance is still probably pretty close to that
right.
800,000, right? So of course there you need approvals to get the exact dollar amount, but having understanding that, okay, they recorded it, they refinanced their home about X number of months ago, they have X number of debt on it, just helps you understand the bigger picture a little better.
Do you have anything else that you wanted to cover on your end of it?
I think it's really important for each of you to have someone that you can rely on to get work done efficiently for title. In reality, when a lot of you are working through title, we're part of one of the open, one of the unspoken parts of the business. And to be, frank with you, you'll work with someone like Jamie or a lender, and they may be like, hey, we're waiting to hear back from title on a certain thing. And just like you would, your clients put in a mortgage application with a certain bank, it sits on a queue line, right? It sits in a pile, and they need to get it in front of an underwriter. Same concept goes with us with title. When you have something that comes into a queue line, that title report's being worked on. If you ever need something expedited, it's great to have someone you can call and be like, hey, the lender's saying they're waiting to hear back from something on title. Can you get this expedited for me? I want to put my buyers at ease, or I want to make sure I'm communicating the best I can. And these are some of the things that we do. We also, like to add value to you guys in any way we can. If that means helping you guys grow in your buyers and sellers, please feel free to reach out to me. I'll explain to you some of the ways we do that. We have a great media and content team. We have a great events team. I think we're some of the more forward thinking title team members. So if you guys ever need anything, please feel free to reach out.
All right, Sean, it's great. You know what? Alan Nickman did have a question. He wanted to know if somebody wanted to order a title just to run the report, what you charge for that.
Look, to be honest, Alan, we would be happy to, build a relationship with you. Generally, these reports cost a few $100s, depending on what it is, if you want a full report or not, and depending on where it is. But feel free to reach out to me. I think, I'd love an opportunity to tell you a little bit more about who we are, and I'll run the report for you complimentary so that we can, start a relationship where we're adding value to you, so that you see, hey, it's great to be working with Shaun. We want to do these things because it's helped make me more aware of the potential property that you're working with for a seller, or that you're looking at for a buyer. So the costs do vary, but if you wanted to know just for your purposes, it could be anywhere from $500 to $650, $700 for all encompassing full title report. Generally, individual fees, individual searches have their own little fees, right? So like a lien search would be anywhere from, call it around $300, right? It would be what these things charge. But for us, we're about relationship based building, right? Like I mentioned earlier, we're all in sales here, so we're all relationship based individuals. But of course, service comes first. So us being able to provide a value add service to you is what's important.
Trace Mack was asking if that was the same with a reverse mortgage on the property. I'm not sure what the
Yeah, it's the same thing. If for
okay.
us, it's the same thing. How it's recorded, it's the same thing. Once you record a reverse mortgage, it's just the payments or structure changes, but for purposes of filing and it coming up, it's recorded the same way.
All right,
So
good.
for us, it's yes, we have the same data essentially
Okay.
that would be valuable to you guys.
Okay. And like COs, new development, oftentimes you want to see is the TCO in place. You guys could readily, easily do that stuff, right?
Yeah, I had a meeting today. We talked about new development, and like sometimes you'll be looking at a new development project and the building is getting TCO floor by floor. These are things we can make sure that you guys, can help, with you guys so the closings get done, right? And also COs in general. Like let's say you're working on properties in Brooklyn. There's certain areas in Brooklyn where, you're not sure of whether it's two family, three family, we're a lot of properties, these homeowners have lived there for 20 years. They built their porch in the back and they didn't get any permits for it. Like,
40 years even.
yeah, exactly. So these are things that you guys should be reaching out to me for that I can, look up for you guys pretty easily. It's what we do. Most of these things are being pulled from government databases, but being an expert in it that does this all day is kind of where we differentiate ourselves from like the average person just being able to go looking up something on Property Shark, right? We do this, and our reputation and our businesses are on the line for it. So that's why when we put these title reports together, you want to have like a good expert that you can lean on for this stuff.
Shaun, we have a bunch of requests for your contact information. Could you type in where to everyone, your email, cell, whatever?
Please feel free to
Fantastic.
reach out to me anytime.
Okay. Shaun's great. I always enjoy having him. And I just wanted to go over a couple of things where the types of title issues that I've seen that have come up for me that can be beneficial to you guys outside of just like, the sales part of it. A couple of things. Number one, one of the things that's very useful that you guys could be doing is when you get your listings, getting a full list of what the costs are going to be. And so that would include, you can get, like, I would send an email, on to Shaun's site or a site for somebody. I mean, hopefully Shaun's, and just find out, hey, can I get a list of closing costs for this property? And now you're going to have it. You could have it in your write-up. You could have it in your marketing material. The other thing is, I find it really, I often will order a title, especially on single family homes or multifamily property. I will want to get a full list of anything that's open on the property before my clients even sign the contract. And, I can't, hopefully there was no reason for it. Because of, let's just say I order a title because I want to see what's open. If for some reason the deal doesn't close, the title company is not going to charge us for just those searches that we ran. They're only going to charge us if we get the insurance. As as Shaun had said to you, that's more of like a courtesy of what they're doing. So definitely always good to check that. The other thing is that, and I just want to make sure, because you're never going to know what's owed on a mortgage. The only thing that a mortgage coming up on title will tell you is that there is still an outstanding mortgage. So I know sometimes, particularly in the city where the purchase SEMA prices are really high, you're saving, 1.925% of the past paid mortgage recording tax when you're doing a New York City SEMA. So that's something that, it is important. Like, you do want to know if there's a mortgage, especially if you think it's going to be, just like every deal, subject to some form of negotiation. Because if you're sitting there with a listing of, let's just say, a $2 million property, well, then you're sitting with potentially, I'm sorry, a $4 million property with a $2 million mortgage. Well, you're potentially sitting there with $40,000 to play with. And the only way you're going to know that is by finding out whether or not there's a mortgage on the property. So let's just say it's a $4 million, you're getting the listing. The seller tells you that they have a mortgage. It would be smart for you to inquire as to whether or how much the balance of the mortgage is. I wouldn't put in the listing. I wouldn't do anything. I would just keep it up here so that this way, when you do get an accepted offer, if there is a separation between the ask and the want, then you have some money to play with. So on a $2 million mortgage, there's about 40,000. Like I said, it's 1.925%, the amount of the mortgage, rounding up to 2 million to 2, brings you 40, almost, just under 40,000. Now, that could be split between the parties. Sometimes you'll have a deal where, it just gets everyone there. If you're sitting with 40,000, each party getting a bonus 20,000 makes people very happy. So it is, I think it's always smart to find out if there's a mortgage on the property, especially on the listing side. Now, the other thing that is just good information to know. And this is just more for anybody. It doesn't matter if you're a broker, it doesn't matter what you do, but sometimes you just want to know what your title looks like. You know, it's sort of just like you ever Google yourself because you want to know what's out there, what people are saying. Well, it's the same thing. You know, there's nothing wrong with pulling the title and seeing if there's anything open that you didn't know about. It would be so much better to just clear it now. The one thing we also didn't talk about, which goes through the title company too, is doing a survey of a property. Now, there's different types of surveys, and when you're dealing in the suburbs, which is where I am right now and where many of you I'm sure live, is that in the suburbs a survey is a really big deal because you're getting the property line defined, so you know exactly where your lines are. And as many of you know, if you live in the suburbs, that it is all too common that there are variations. You know, I'll give you an example. I'm going to be selling my house on Long Island. And I remember when my neighbor was putting in a pool, they had told me that my fence didn't go to my property line. And since they're putting in a pool and they were putting a fence in, they were asking if they could put their fence right up to my fence. So basically saying, you know, we just want to use a couple of extra feet since you're not using it. And while I'm normally not like that, I'd be accommodating with something. I wasn't accommodating with it because I didn't want to get into a situation where I get a buyer and now my buyer gets a survey and they see that my neighbor's fence is on my property and now it won't be. So that's why I didn't do it. So the survey, you know, when you do a survey, you're also seeing, you know, it's not just about like, is something on the property that doesn't belong there? It's also variations where the owner is not using all of the property up to the property line. Whenever you're not using property up to the property line, it's going to be what's called an exception on title. Now, just because there's an exception to title does not mean that you can't close at all. It just means that it's not insured, but we don't care about we don't care about property being insured. That is our property anyway. So for example, if like my property line is here and my fence only went to here, this area, the title company of the buyer is not going to insure because I didn't build, you know, put the fence all the way to the property line. Not a big deal though, because it's my property and it's still, the survey will show that it's my property and there's nothing else on it. Now, if there already was a survey from the property, which is very possible, then what you can do if you're selling your property or someone's buying the property is you can just give the old survey and have the title company have it updated. If the same survey company is available because they're still in business, use the same company. There's no reason not to. With the survey, you could just get it updated, but you will want one. If you're getting a loan on the property, you will be required to have one. Getting title, ordering title is something that we do as soon as we're in contract, and then we update it within the same day, within 24 hours of the closing, just to make sure that nothing got put as a lien on the property prior. So that's really it on title. Does anyone have any questions for me on that? The only other thing I'll say is, you know, a lot of times, like as Shaun was saying, most of the research that gets done where people are finding out whether or not there's a blemish on title, it's really stuff that, I mean, I do it myself. We do our own searches on HPD, DOB, ECB, but we also order the searches. So I do have my clients pay the cost to do the order, but we still also do our own due diligence on it, just to as a cross check. I'm not worried about missing something because that's why we're getting title insurance. I just like to look into things maybe even before they might come up, or they might, maybe no one's going to necessarily order title yet, but I just want to check on some things. For example, anytime I have a client that's selling, I always will check the property on the Department of Buildings website because I will want to see whether or not there's an open permit, any liens that come up, even though I'm still going to have the abstract company check it for me and get me copies of everything. I want to see that up front because before I'm going to contract with my client, I want to be able to address any open issue. If I'm the sell side, I want my client to know about it even before they list it. If it's something that needs to be closed out, we should address it now. And if I'm the buy side, I want to make sure I look it up. I want to make sure that depending upon what it is, there are times where something's going to come up and I don't even want to raise it. Maybe we'll raise it after we're in contract. Now, the risk then is the seller doesn't necessarily have to cure it if you didn't raise it. You just would have the right to get out of the deal. Depends what your client wants. So I think that just that's pretty much it on the title. Most of the stuff you really don't have to concern yourself too much with. It's certainly worthwhile one of these days looking through a title report just to see what they look like, and just good terminology. Exceptions and omissions. An exception means that we're issuing you a title insurance policy. However, it's not covering this. And what that this is are called exceptions. For example, an owner is renting out the house. There's tenants in place. Tenants are exceptions to title. Tenants don't affect title. Title is affected by judgments and liens. When there's money owed, when there's a physical encumbrance on it, maybe it's a townhouse in New York City and the retaining wall from the neighboring building fell onto the wall of your building or fell over the wall of your building. I had a client had that exact situation. And so it's definitely important to have a basic understanding. You don't need to know that much more than that. And in another couple of minutes, we're going to have Jonathan Miller coming on here to join us. Jonathan Miller is from Miller Samuels, and he really is for me, ever since I've been in real estate in New York, it's Jonathan. Jonathan's my go-to for anytime we need appraisals. Now, where it comes up a lot for me, I'm doing the sale of a property and it's in an estate and no one did an appraisal back when the decedent died. They ended up renting it out all of these years. And so now that they're finally getting ready to sell, we might need to know what their cost basis was. And so Jonathan he's the guy for that for sure. He's the guy for anything appraisals, whether it's an entire estate, it could be art, it could be a home, it could be really, he'll get into it and share all of that with you. Hi, Jonathan.
Hi, nice to see you.
Nice to see you too. How are you?
Living the dream.
I was just actually giving a little bit of a background on you. When you're doing appraisals, it could be a full estate, it could be asset, all kinds of things, even in the home, or is it just the real estate?
There's different disciplines. So there's appraisers that appraise personal property, like you have an estate sale and they appraise the artwork in the house. That's a different discipline. We appraise the real estate.
Got it.
Uh, and it's like law. There's different
Sure.
flavors of expertise, and appraising the same way.
Absolutely. Absolutely. Yeah, I was explaining how in my business, and I've had your firm do this for me on many occasions, is that I have somebody that passes away and the family might rent it out for years. They might
Yeah,
live in it for years. And then all of a sudden it's like 30 years later, and now they're finally getting ready to unload. So can you kind of just tell us, because I think this happens a lot for brokers too, and
sure.
maybe where and when they should be having a conversation with you.
So there's, I'll back up just a half step before that to set the stage. So when you think of an appraisal, the need for an appraisal, think of it as a snapshot of a moment in time. So when an appraiser meets you on site at the house for a mortgage appraisal, that's almost 100% of the time it's current market value. It's the value as of that day that you're walking in the house. In an estate appraisal, um, uh, it's usually called a retrospective valuation, meaning you're going back in time. So it could be the date of death. When we do a lot of matrimonial work, it could be the date of the marriage 20 years ago and the current value to look at the difference in value between the two dates. And that is to be decided usually by the executor or the attorney managing the estate. The appraiser has nothing to do with sort of determining, what the valuation date. In fact, that's the first question when we're engaged to do an estate appraisal is what is the date of death or valuation date, because that impacts the comps we select. So for example, if we were doing a date of death appraisal, like in the example that you just gave, Jamie, where someone passes and then maybe the family keeps the property and 10 years later, well, maybe there's a need by the state to establish a value 10 years ago in addition to the current value. Um, uh, the fact that, if I go back in time 10 years ago, I can only use comps and inventory or listings that were available that you would have been aware of at that as of that date. Even though I knew that 3 years later, the house next door, which was identical, sold for X, that's not a base, that's not a comp, because it didn't exist as of that moment in time. And we do a lot of that. There's a lot of things that need to be established as of a certain moment of time. We also are asked to do prospective valuation, which is, what is the value 2 years from now for whatever reason? We've had crazy, situations come up where they need to know. And obviously, we don't see the future, as much as easily as we see the past. So there is a methodology of why you think, maybe you're thinking prices will be 5% higher. You don't know that they'll be 5% higher as an appraiser or you as a broker. But based on, mortgage rates I'm making this up, mortgage rates happen to be trending lower, inventory is tightening, then you can explain the rationale why you think prices will be higher a year from now. And that goes into the valuation. So you appraise something as of current, and then you'd sort of, take that result and grow it based on, the interest rate trend or inflation or whatever, to come up with a number. The only restriction you really have is explain how you did it so that somebody in the court, the attorneys, all the parties understand where that number came from and how you came about it.
What would you say timing wise? How long does it take? Somebody does it depend upon how far back you're going. You
Yeah, so the farther you go back, the harder it is, to do. So it takes a little bit more time. But like a typical a state appraisal is probably, a day or two longer than a bank appraisal. Like it's not, like you have to reinvent the wheel or anything. It's just that it's just a little harder, especially in markets where old data is terrible. I'm exaggerating here to make my point, but in Manhattan, Manhattan data wasn't public record till 2006. And so let's just say and I've had to do this, date of marriage was in, 2001. And I've been asked because in matrimonial valuation, sometimes they'll ask us to say, look, you've got, they'll try to figure out like one party, um, spent all the money when they first got married to renovate the place. So how much of the price change over the last 20 years was attributable to, they call it passive or active appreciation. Like passive would be just time, and active would be that, one of the parties spent $100,000 renovating a couple of things in the house. And so, there's logic to that and how you present it. But the idea is that, if I go back to 1991 or 81 or whatever, some really far back date, and it wasn't public record in Manhattan specifically or New York City, then that gets really hard to find or to dig up. Maybe with AI, it could be a little bit easier, maybe, but the idea is the further back you go, the more expensive and the more difficult or challenging, and the less reliable the valuation is, just because there's just many more variables to consider.
Right. Now, Jonathan, I know for a while, for me, it seemed like, I guess, like post-COVID, there was definitely a time I did feel like properties were not necessarily appraising as much. And I do feel, I don't know about you, but I mean, obviously there's a lot less financing also, but even so, financing is fine. And it's come back a lot now. I haven't seen properties not appraising. And I'm wondering, is that a reflection of standards lowering, or is that a reflection of, what is it?
I don't think it's about standards. I think it's about price growth is much more muted than it was 3 or 4 years ago, where everything was like straight up and to the right for pricing, and so it was hard to keep pace with the market because the data was lagging what was actually happening on the ground. And actually, for those of you that are interested, I have a newsletter that's free. It's at housingnotes.com, and I write 2 or 3 times a week. And the last article I wrote was yesterday, and it was about anecdotal data, and um, and so I have this saying where, in the brokerage community, an agent and say an expert in a submarket will say, well, I had this sale and this sale and this sale in the last 6 months. And that's how they see the market, right? But just making this up, none of the reports have come out yet during that time frame. There's no, like, I can look it up somewhere, right? It's just based on anecdotal, and there's a saying that the plural of anecdotal is not data. That's what I like to say. And the reason I bring this up is because the Fed, I've been talking to I'm interviewed by the Fed 8 times a year for their beige book, um, and it's an anecdotal story about uh, the economy, housing, healthcare, labor, like everything. And I sort of represent the sort of New York City story about housing and real estate. And it's all anecdotal. And the reason for it is because anecdotal, when you go to somebody that's a trusted expert, like me calling one of the agents on the call here about their submarket, and they're telling me about a couple of sales or they heard rumors of whatever, I'm not talking to somebody on the street. I'm talking to somebody that knows that submarket really well. And so in many ways, their information is a leading indicator. Like it's ahead of if I published a contract report, market report in that neighborhood, but they've got like this earlier data or this contract data that we don't even know about yet, then that's like a leading indicator. So anecdotal, my long-winded point here is, anecdotal, sort of storytelling data is also useful. Like one of the things that an appraiser should do is when they're writing about, they're putting comps on the grid and they're making adjustments and they're coming out with a value, is that they should also be telling the story of the local market. Like What was really common, Jamie, in your example was there were periods of time where, prices are straight up and the data didn't prove it, right? Because it was so crazy, right? But I could tell the story that there were seven backup offers on this property. Now I'm not putting, there's no place on the appraisal form to put that, but I could say, and it's sold in 5 minutes, and there were seven backup offers, and that's why I'm adjusting upward significantly for time. And there's ways to sort of talk through when markets pivot really quickly, whether they go straight up or straight down. And appraisers that aren't local market experts that are coming from 3 hours away because they're the low bidder for the national bank that bid out the job, then they're probably good for you when the market's falling because they're going to be late to the party, but then they're going to be bad for you when the market is surging because they're going to be late to sort of adjust the comps higher because of the condition has changed. Anyway, that's my long-winded point.
No, no, it's good stuff to hear. Look, I always love to ask you this question. I'm sure everybody on here is also interested in hearing. So tell us, what is, starting from, I guess, January 1? Since January 1, what are we seeing? Where are we trending? I mean, it does sound like there's more deals out there. I know that, it's forget 2021 and 2022. Those crazy times are just
Those
gone.
are historic anomalies.
Exactly.
That is
Exactly.
not a basis of reference at all.
Correct. Right. I mean, look, as long as deals are happening, so what are you seeing out there and,
Sure.
and at what price points?
So what's really interesting is um, in the first couple weeks of the year, like the data we were getting from national outlets, like or even at the end of December, was showing that there was a big drop in sales, and this was nationally, like we were seeing everywhere. But and I cringe when I say this, but it was the weather, because we have 340 million people in the US, and something like 270 million were impacted by the storms. And so I just remember back in 2014, we had a polar vortex in New York, and it was like, my company, we don't just do purchase appraisals, we do estates and trusts and divorce and things that aren't dependent on interest rates or, financing. And everything stopped. And I remember talking heads were saying, well, that's it for the housing market. It's going to set it back 5 years. And I'm thinking, think of a couple that leaves their house to go look at houses with the agent and they see it's 0 outside. They don't say, well, that's it. It's too cold. Let's wait 5 more years, right? They just say, well, let's wait a few weeks or next month, when it's a little more sane to walk around. And that's exactly what has happened nationally. So as a result, just, at the higher end, or the sort of 30,000 foot view, is that transactions are ahead of last year. You can see it sort of the slowdown in January, I believe, was weather related, and so do most economists. And there's been an uptick in February. Um, One thing that, although I haven't updated, or we haven't done because the first quarter isn't over, but the Long Island report that we published and the Hamptons report showed record prices at the end of last year, record prices, sales sort of flat, and inventory drifting lower. So it's kind of more of the same, where it's just the conditions are remaining tight. And when I was asked the question that you asked Jamie in 2023, I said 2023 is, is going to be, I called 23 the year of disappointment, because everybody was like, yeah, 20, but 23 was sort of coming out of that pandemic surge. And then in 24, I described it as the year of less disappointment because 24 was more active than 23. 25 was a little more active than 24, and I do think 26 is going to be a little bit more active in terms of transactions um, than it was in 25. So what I see is incremental improvement, and a lot of that comes from two things. If you think about if we could just simplify the housing market completely and just say the upper half is more dependent on cash and the lower half is more dependent on rates, right? And so if you look at the upper half of the market, both nationally and New York Metro, cash purchasing is at all-time highs. And the higher you go in your net worth or income or the property price you're looking for, the higher the probability that the buyer is going to pay cash or substantially with cash. And that's a way to bypass higher mortgage rates. However, since uh, early July, mortgage rates have fallen over 60 basis points, and that has uplifted activity in the lower half of any given market. Uh, Not in the context of a boom, but this isn't exclusively a high-end narrative anymore. Like we had a lot of that in 25. This year is, I think, more balanced. And even though the Fed is only forecast to cut rates one time, I've had a few economists think maybe two times, but one time. But mortgage rates are expected you know, sort of slide a little bit. And by the end of the year, be below six. Now, buyers can get mortgage rates below six. Like it just depends. I'm talking about the generic retail sort of what rates are, for sort of full retail. High end buyers, have relationship managers at banks. They can get five and a quarter, no problem, right? I mean, but I'm just talking in the context of sort of national public numbers, and you can definitely, for a lot of people, they can get lower than that. But the idea is that rates will sort of incrementally drift lower in 26, not dramatically as the economy continues to weaken. One of the reasons why rates aren't a lot lower is because tariffs are sort of embedded into the economy and are keeping um, the ability of the Fed to cut rates further in check. Um, and the Fed doesn't want to cut rates if, inflation is sort of stuck, and it's stuck around, even though it came down to below 3% the last couple of months. The reason it did is because of closing of the federal government and some missing sort of holes in some of the data and the way like inflation isn't 2.4% right now, even though that's what was published. It's closer to 3 and probably is going to be stuck there for a while.
What do you think is going to happen now with the taxes here in New York?
Yeah, so I do think that there's probably going to be, that's one thing you can always count on, right? Death and taxes.
Yep.
And so that's another headwind for housing, for sure. But I'm not sure if it's going to have a dramatic impact.
I mean, if it
But
goes to 9.5%, it would.
well, yeah, yes, exactly. Like,
It goes
and
up.
so think about what that does to the housing market, right? That uncertainty, that layer of uncertainty that you don't know, but that's a possibility. So you end up going through all this, you buy something, and then all of a sudden it's a big jump. Um, so that is a headwind, for sure, and it does
Certainly,
take.
it could help the suburban market, I imagine.
Yes, yeah, that's the potential there. Uh, but one of the things that happened, I live in Connecticut, so I don't vote in New York City, but my business is in New York. And one of the things that was a big part of the conversation last fall was the new mayor and the wealthy are going to flee the city. there's a lot of that sort of concern, and you have to remember that over 50% of tax revenue in New York City comes from real estate related activities. So it's real estate is such a huge component of the for future success of the city. But
Aside from the fact that they get so much money from so many of the high net worth,
oh yeah,
they're paying so much in taxes because they're not here.
right, right. So
They're,
yeah,
they're
it's
paying
very
taxes and they're paying
yeah,
so
it's very so yeah, no doubt it's very expensive. And but I'm uh I'm what we call an evidence-based researcher. So I'm looking for real numbers, not headlines, like what
right.
happened. And so I track new signed contract activity, which would be contracts that were only like if I when I, before the election, so I do in October, I did one every month. And so October, I'm only looking at contracts that were signed in the month before the election. And and how many new listings came onto the market. Because there was a narrative with the new mayor who only became public knowledge or public facing until beginning in July, the first week of July, he became a sort of a known entity. Um, and this whole story about sort of the wealthy fleeing the city, the taxes and everything, started with real estate agents in Greenwich, Connecticut, who were saying their phone is ringing off the hook because people are fleeing the city because of the new mayor coming in. And and I and I um, I wasn't seeing that in any of my data, but the phones were ringing off the hook. The reason the phones were ringing off the hook was because Wall Street in 2024 had record compensation and record profits. And guess what? In 2025, they're ahead of 24. And they represent only about 3% of the New York City wage earners, but they represent about 23% of wages because they're highly compensated. And each job provides supports six private sector jobs. So they're very important. And they had a great year. And they've had two great years in a row. So what happened because of that? We had a lot of high-end sales in the city. Sales rose every quarter in 2025 in Manhattan. Every quarter it rose, uh, and prices rose in every quarter. So people weren't fleeing the city, and contracts the month before the election and the month after the election were off the chart. So, so, so I was always asked, like, is that, how should we think about the housing market? And I said, well, it's doing really well. Sales are up, contracts are up, prices are up, leases are up, lease signings are up, inventory's down. Like, it's like everything is going in the right direction. I don't know, maybe 6 months from now that changes because of new policies, but there's no evidence that the wealthy are fleeing the city in any way. The Hamptons had record sales, price or not record sales. They had record prices. They had inventory nominal, like inadequate. It was just all, and that's all related to Wall Street. Wall Street is joined at the hip of the Hamptons, right? So there's a lot of times there's actual data, housing data, to sort of, to keep your consumer informed so that they don't jump to conclusions. One of the things, Jamie, I found in downturns, I can't remember if I already said this now, I'm probably losing it. But I find that the real estate agents who are, I know hundreds, tend to be more negative about uncertainty than consumers are. And that's something I've learned in my, you know, 40 years of appraising in New York. So it's important to just stay current on
Is that
what's
because
going on.
they're jaded?
No, no, I think it's because they're, a broker's income is transactional, right? And transactions are down when the market is weak, right? And transactions are ahead of prices, like they're a leading indicator in,
Right.
contracts or closings ahead of prices themselves. Prices are the caboose on the end of the train if trains still had cabooses. It's like the last thing when the dust settles, the price is established. But what starts out in the front is transaction volume, inventory. Those are the things you should be paying attention to in terms of how the market, the direction the market is going. And in my mind, the most important metric has been for the last like 4 or 5 years has been inventory, because how can you explain how prices can be rising when mortgage rates are more than double what they were, 5 years ago?
When is your expectation that we're actually going to see the movement though in rates? Do you think that in the next 6 months? Is it 2 months? Is it
I think that it's going to be just this sort of slow drift. It's nothing. It's There's not going to be a correction in rates. I think that's a way to think of it. It's going to be slow and steady, not dramatic. And my goodness, I'd love to have less drama related to the economy and the housing market, because that's the biggest sort of headwind for consumers to wrap their head around. Like, I just want the world to be very boring right now so that people aren't looking for reasons not to buy or to make their move. I always I probably have used this every time I've talked to you, but I just this analogy of, you know, many consumers are waiting for lower rates, but prices are rising, right?
yeah?
So the condo buyer, the couple that bought a condo in 2022, and they had triplets. Like, how long can they wait for lower rates? Because prices are higher, and are probably going to continue rising through this year, if not next year. And the reason for it is inventory in the suburbs surrounding New York City is a fraction of what it was pre-pandemic.
It's
And,
nothing.
it's like 20-30% of what normal is. The market share of bidding wars of things that closed in the fourth quarter ranged. The high was in Long Island, where, excluding the East End, Long Island proper was 52% of all the closings. So one out of two sales sold above the last asking price. And that's my proxy for bidding war. And then the same in Westchester and the same in Fairfield County. It's um, inventory, even though it's rising, it's still a small fraction of what normal inventory is. So, like in Long Island, normal inventory, meaning if you average every quarter for the last couple of decades, normal inventory is about 15,000 units. Just before the financial crisis, it was like 26,000. So it was really bloated. But normal's 15. Right now, it's about five.
Yeah.
So it's one third of normal.
Yeah. I mean, one thing I think that I think will change that will be that, look, we're going to be getting into the spring market.
Mhm.
And because price, I think that sellers can demand higher prices.
Yeah,
And the reason why they're going to demand higher prices is probably the same reason I will, which is if you're sitting on a mortgage in the twos, it's like, all right, well, if I could get my number, I'll sell.
exactly. That
That's
is
really,
the
I'm
exact
just,
logic. That's the
yeah.
exact logic that I'm hearing from
And
a
that's going to
lot of
help.
parties.
It's certainly going to help people. I mean,
The
I'm
the
going to be,
prob the
I'm
problem.
downsizing soon and I'm going to be listing.
So I agree with that. That's a way to rationalize, why you would sell, right? Because
Right.
you get less for your money when you have a 6%, 6.2 mortgage versus a 2.75, right? You get
Right.
less for your money. The problem or the challenge is that the buyers are much more constrained because mortgage rates are a lot higher than they were, right?
I think it's the,
And credit is still, it's not like oppressively tight, but it's not like it was during the
no,
bubble where you just needed a pulse or
Right,
be able to fog a mirror, then you can get any
right.
mortgage you wanted. And like it's responsible. Like that's why we're not going to have a banking crisis, is because lenders didn't lose their mind over this,
But
you know,
I think
boom.
though that there is a part of the market that might not apply to. Because if you think about like the luxury market, your luxury market that got twos
Yeah.
in 2020 and 2019, those people that got them, like myself, the value of the house is up tremendously.
Oh yeah.
So,
We have like the highest home equity
and what
rate in
about
the
the people
country.
like myself? If you're downsizing and you're in a luxury product or at the high end,
Yeah.
this is when you want to sell.
Right, right. The challenge there is that people look at the low rate as an asset. It's like a thing that they have that time forgot. Time has moved on,
Yeah,
and they still have that 2.75,
yeah,
and they don't want to,
yeah,
give that up. The question is, life keeps moving on.
that's right.
And so that's why you have an uptick in inventory because those people have made that decision. More people are making that decision, but it still is keeping supply off the market, which is keeping prices elevated. Like it
Yeah,
is, never in my life did I expect, the ebb and flow of the housing market is, one example would be, mortgage rates spike for whatever reason, sales slow, and inventory soars, prices come down, right?
right,
But in this cycle, uh, inventory rose, sales fell, uh, inventory remained low, and so prices didn't correct. Yeah, nationally we're seeing, more decline in prices, but in aggregate, especially in the New York metro area, you're not seeing that. In fact, on social media, there's a tremendous amount of misinformation about that I keep reading every day about, inventory is huge, gigantic, supplies everywhere.
yeah.
But
I thought I was reading an article from years ago when I saw something like that yesterday.
yeah, and the
I was like, why?
reality is
What?
that the northeastern United States and the Midwest are devoid of supply.
Right,
And the Sun Belt, like Texas and Florida, have much more supply. But I cover 14 markets in Florida, and every market, either on the ocean side or the Gulf side, in the fourth quarter, saw almost every market of the 14 saw uh, inventory growth really pull back, and some markets declined comparing to pre-pandemic. As a benchmark, that inventory is not just skyrocketing. It's really sort of uh, it's a little still in most markets a little higher than pre-pandemic, but it's not insanely high. And sales are beginning to rise again. So you can't like say, well, Florida's got more inventory. Yes, it does. Texas has more inventory. Um, but it's not like this massive oversupply in every market. Uh, and then the West is I cover like California, and my new venture we're covering like California, Nevada, and we're soon to cover Arizona, New Mexico, Utah, sort of big chunk of the Southwest and the West. And it's kind of the same thing where inventory is more Goldilocks. It's not too high, not too low.
right.
It's sort of in between the Northeast and the South. So inventory is, as I said earlier, is the most important metric in housing today, and it varies dramatically across markets.
As far as the outer markets, like upstate, you're
Mhm.
mentioning the Hamptons. I know we saw a very big uptick, of course, during COVID, going upstate, Catskills, Hudson, all those little towns up there. Are you still seeing a lot of that?
Oh yeah. So I live in Fairfield County, Connecticut, and Westchester to my west. Sort of the Hudson Valley, if you just go straight up, Putnam, Dutchess, and further, it's become this sort of mini Hamptons, where housing prices are dramatically cheaper. It's still like 3 hours away from the city, but people are buying land and, it's a lot cheaper, but the prices have, gone up dramatically, even though they're still cheaper than the South Fork and all that. But that was a big focus. And the reason for all the migration we saw during the pandemic, outbound migration outside of the New York City metro area, was the search for cheaper housing. And I have this word I'm trying to get into the Urban Dictionary, which is Florida has gone through what I call a New Yorkification,
Huh.
where the discount to move to New York is not anything like what it was. In fact, it's almost essentially gone or very close to it if you're on the ocean side. If and as a result, in Long Island, you've got this surge of demand for 55 and older housing because a lot of people are not retiring to Florida anymore. It is not like I think that
Not a
migration,
bargain anymore.
it's not a bargain anymore. It used to be, it went through like it was the retirement capital of the world. And
Yep.
then during the housing bubble, it was the foreclosure capital of the world. And
Yep.
then it became the new luxury market. And we're seeing, some,
Well, you know what it is also, though, I think, Jonathan, I feel like what happened with Florida was the inexpensive places were really where everybody was retiring to. They didn't have, you had like that one development in Boca when it first all started. I'm talking like 19 late 70s, early 80s
yeah,
now.
yeah,
And you didn't have all the luxury.
right.
Now, the
Yeah.
places that everyone was moving to for retirement are considered like, they're that's not where people are moving. Those are like now the low end market.
And actually, a lot of the new product is like inland,
Yep.
because the old stuff is on the ocean. So it's very different, and it's interesting. Uh, Kind of going down a rabbit hole is that the Gulf side is much weaker as a housing market than the ocean side, and the reason for that are Canadians. In our sort of trade war with Canada, Canadians are sort of not vacationing in on the Gulf side like they were, and selling their homes. So there's more inventory and less demand. So it definitely pricing there is much softer, whereas the ocean side is um, you know stable, if not seeing conditions improve, especially in the last couple of months.
Does anyone have any questions here for Jonathan? Oh, here we go. Can you see that, Jonathan?
Yeah, yeah, I see it. So when land leases get reset, is the appraisal done by more than one appraiser? Who selects the parties? Is there any legislation you know of? Carnegie House facing a 450% increase in the ground lease, um, creating financial havoc to the owners. Any thoughts? So I actually pro bono worked with a group. I think they were sort of working with the board to try to solve the problem because I was the appraiser. It was about 10 years ago that, and I promise, Jeffrey, I'll answer your question. Let me just sort of lay the groundwork. There was a building on the Upper East Side on East 61st Street and Lex known as Trump Plaza, and that was on a ground lease, and the ground lease was expiring. And the maintenance is already very high. So, with a high maintenance because of the ground lease payment, um, you know, properties, like you buy a 900 square foot one bedroom at the time, this is 10 years ago, and a 9 bedroom condo on a medium height floor, and the monthly common charges for that apartment or the maintenance for that apartment was like 900 square feet. It was like $3,000 a month. It was a big number. When the land value resets, the predicted number is going to be 14,000 a month. So someone that buys that apartment, if they were just, it was just a pure investor, but the apartment doesn't, it won't rent for 14 or 15. There's no upside. So it basically has no value, and the co-op would collapse, and everybody would lose their equity, and it would become a rent stabilized building. And that's what I understand. So it kind of catastrophic. And what my experience was, um, with the ground lease, and actually I've done a bunch of these over the years, is the parties often hire two different appraisers. The ground owner and the co-op board will often hire two different parties, and then the parties, you know, negotiate what the value is, between the two appraisals, or they'll get a third one to split the difference or whatever. Um, um, I've always found that they tend to go with me. So not to not to sort of hard sell myself, but because I'm not like roses and, kittens and bunnies and everything's happy. I'm just sort of telling it like it is. And what happens is, what happened with Trump Plaza, it was really cool. I couldn't believe it. It was, I think Rebney called it the deal of the year, where I spoke to the shareholders. I told them about the tsunami coming, and what was going to happen. And what the board did is, if you own, say, an apartment worth, I'm making this up, is worth $1 million, and you would have to buy, um, like they were going to get a chunk of money and buy the land from the landowner, so they would have the land. But you can't just get a mortgage through the co-op and have like a second or third mortgage, because your maintenance would still be 15,000 a month. It'd be some crazy number, which would make it unmarketable. It doesn't solve anything. So what you end up doing is you end up buying, you get a mortgage outside of the co-op, and the individual shareholders were sort of got a pro a per share or a pro rata amount that they had to come up with money, and they would get financing, and a bank sort of offered to do it. And out of like 144 unit owners, they got like 142 to do this. And it wasn't like a small amount of money. Like if I had a 900 or $1 million apartment and I was trying to protect my 300,000 in equity, I'd have to take out like a mortgage for $700,000. Like there was like massive skin in the game. And a lot of people in that building were very elderly. And I just thought, there's no way. But the board president loved the building, grew up there as a child, and wanted to preserve and everything. And he was a Wall Streeter, and he figured it out. And it was a success story. So the problem is, and this is a basic sort of valuation concept, is that land appreciates and the building on top of it depreciates. Um, so when you think of why housing prices are so much higher, say in Long Island, Nassau County, than they were pre-pandemic, that's, universally, most of that is attributable to the land. Yes, if you put an extension on or renovate your house, but the majority of the appreciation over time is related to the land, or depreciation in terms of dropping value. And it's an important concept. So in with land leases, um, the co-op doesn't own the land, and 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 so the landowner, land is right now at a big premium, because there's been so much price growth nationwide. So just even building a new development, land is very expensive to assemble. Forget, labor and, you know, uh, construction, materials, that sort of thing, just land itself. So there are people, and this is an example of it at Carnegie House, where you can buy apartments really cheap there, but the reason they're really cheap is because the maintenance is massive, and it could blow up even more, just in a few years. So so but those investors are sort of counting on they're literally betting on the co-op to go under and and eventually, take over the site and build a new building on it. Like it's this sort of perverse way. It's the long game, because I don't know when they bought a long time ago, but that's what they're doing. And I was involved in another one in Chelsea that was much like that. So, um, but it is a very small part of the market. But they are a massive red flag for lenders.
Yeah. Yep. They are.
That's a great question. Yeah.
And let's see.
And just remember that people that bought, for low prices, even, a long time ago, that's the reason the price was low. Um, it's not because, the market or the seller didn't understand the market. Like that's why. So when you buy into that, like I was kind of amazed at Trump Plaza because like I asked the board president when I spoke to the board as I was engaged, I said, didn't weren't the buyers aware that like within, I forget at the time, like in 15 years or 12 years, there's going to be a massive surge in the ground rent lease payment and the maintenance is going to surge. And he said, almost everybody's unaware, which is crazy to me. So
Well, thank you, Jonathan Miller. This was fantastic.
if you want sort of conversation about this, um, in the manner that I'm sharing with you, I write regularly at um, housingnotes.com and also have quite a few dad jokes on there. But housingnotes.com, lots of issues of the day that your clients are probably asking you about. And then my appraisal company, which is Miller Samuel, and we cover the New York City metro area for all kinds of appraisals, estates and trusts and divorce and purchases and all that sort of thing. So feel free anytime.
Jonathan, always a pleasure to have you. I really
Likewise.
appreciate you
Thanks.
joining
Thanks,
us.
Jamie.
Thank
I'll
you.
hope to talk to you soon.
All right, definitely.
Bye
Thank
bye.
you. All right, everyone. So this was great. Always love having Jonathan on here and Shaun, and love seeing everybody here. Talk to you soon. Thanks.